healthcare, the only two S&P sectors in the red right now, and markets on another record run on this Friday. Let's get right to the floor show. Perfect person to be with us, Interactive Brokers Chief Strategist Steve Sosnick. And Steve, we haven't even gotten to the December jobs report, which, by the way, came out this morning, and it showed that we saw fewer than expected jobs created in the month of December, a 50,000 gain there in the jobs world, but better than expected unemployment rate of 4.4% versus 4.5% expected, and the November read of 4.6%. So what part of that, whether it's the jobs report or all this other news that is flowing, whether it is in the semis or out of Washington, D.C., is really driving these market records right now?
Well, Happy New Year, Liz. It's great to see you again.
Thank you. You too.
What I think is driving it is hopes for a stronger economy. And obviously, you know, you could focus on the non-farm payrolls and say 20,000 here or there. Remember, that's 20,000 jobs out of a workforce of about 175 million. It's a bit more important to see like the unemployment number beat. It did have a little bit to do with some labor force participation ebbing, but 4.4 is a good number. This is the thing we have to keep in mind. I think we reset our mindset actually on December 23rd, when the GDP number came out and blew away estimates. I think that, but the problem was we didn't do anything for the 2 weeks ending the year because many of the portfolio managers were on vacation.
Okay, but you know what's really strange to people? It was a miss. I know you're saying focus on the better unemployment number and the fact that that came down, but you've got Treasury yields moving higher, and now the Fed funds futures indicate basically an absolute no way that we will see another rate cut, at least at the January meeting here for the Federal Reserve. I mean, yesterday, Fed funds futures were at 15%, or 13, let's say 13, I think, because I was at CES running around and I glanced down at the 13% odds of a cut. Now it's down to 5%. Why is that?
Because here's the thing, when push comes to shove, rate cuts are nice. A strong economy is better, because rate cuts are helpful for money flows into the stock market. They're helpful for investment. But bottom line is, a strong economy lifts earnings.
But you had Jay Powell a little bit more worried about the jobs picture. Now you have Raphael Bostic coming out today, of course, the Atlanta Fed, and saying that we're in a no hire, no fire atmosphere, and that the jobs market is certainly cooling off, but. Who knows? Let's move it to these records.
Sure.
For the S&P, the Russell, the Dow, the transports, it doesn't appear that anybody is getting off the stock investment train, at least at the start of 2026.
No, because why? When you can have your cake and eat it too. You can get if the economy weakens, you get rate cuts. If the economy's strong, you get earnings. And look at the stuff. Look at the stuff that's winning. Transports are very economically dependent. You mentioned home builders. Granted, there was some specific news there. Utilities, again, specific news. But the Russell is being driven by the hopes for the economy, because these small cap companies, many of which are unprofitable, yes, they benefit from rate cuts, but they benefit much more directly if there's a robust economy and they can sell stuff to other companies and other people.
The Russell is a rock star so far in these first couple of days of trade for January. And does that mean that the tech trade is dead? We don't think so, especially considering we just came from CES in Las Vegas. And how do you command the CEOs of every major semiconductor company? And it's a consumer electronics show. It wasn't a chip show. Now it feels like it is. And then you've got the nuclear story. Power is going to be key. Pat Gelsinger is coming up. He's now in venture capital. He was the former CEO of Intel. He is all about making the energy piece of the compute demand as almost of national importance.
I don't think you can have a rotation without kicking the old winners out of the cupboard, let's say. So we're getting, tech is okay. There's nothing wrong with it. People are moving beyond it, though, and that's where I think the economic story is. We're seeing a rotation. The activity I've seen this week strongly indicates that institutions are coming back into the market and looking for things other than those Mag 7 stocks to put their money. They're looking for value. They're value investors, and they're finding it, and they're getting the tailwind from good economic reports like productivity and GDP.
Okay, what are your stock screens telling you will be sort of the surprise gainer this year?
The surprise gainer, I don't know that there's a ton of surprises. I think right now, economically sensitive, I think people are going to gravitate toward consumer discretionary in the short term, but I think still it's going to be staples. It's still going to be Basically things that benefit from a decent but not a robust economy. I think more staples, and I think dividend payers are back in focus now, and I think they remain in focus.
Yeah, well, that would be some of the utilities, wouldn't it be?
Exactly.
Thank you so much.